Okay, great. Good morning, ladies and gentlemen, and welcome to this special edition of Marcellus webinar. My name is Hardik, and I'm going to be the host for today's session. Along with me, we have Rakshit Ranjan, who's the fund manager for Consistent Compounders PMS, and Arindam Mandal and Javeer Sethi from our Global Compounders team. The concept of double engine compounding was originally discussed in July of 2023 in form of a newsletter as well as a webinar. However, we thought it's an opportune time to revisit this concept and look at how the numbers stack up from then till now. Before we dive into the 50-50 GCP, CCP or India-US combination portfolio, it's important to look at how stock markets around the world have actually performed over different periods of time. And what is clearly represented here, this is data of countries converted into dollar terms for likewise comparison. And we've realized that over the long term, in fact, US and India have been the best performing stock markets, whether you look at them from a 10-year perspective, 20-year perspective, or 30 years, which clearly tells that over the long periods of time, these two countries have delivered great stock market returns for investors. Now, if we dig deep into how a combination of Indo-American portfolio looks like, for the benefit of everyone, we did this exercise on S&P 500, which represents the United States, and Nifty 50, which represents the Indian index. And we did a 50-50 each. So if you were to invest 1,000 rupees in a combined portfolio of Indo-American from January of 2004 till December of 2023, you would have made approximately 15,000 rupees. In another ways, by investing in the combined portfolio, you've actually made up for the entire returns of Nifty 50. But at the same time, the journey to reaching these returns, the volatility or the risk as measured by standard deviation has actually been significantly lower, which tells us that you still make good returns from investing in a domestic portfolio like a Nifty 50. At the same time, you significantly add stability to your portfolio by getting exposed to S&P 500 as well. Now, these are back-tested returns for last 20 years on the benchmarks of S&P 500 and Nifty 50. However, if you were to look at this on actively managed portfolios from the bouquet of offerings from Marcellus, the data is actually even more interesting. Please note, Global Compounders offering was launched in October of 2022, and hence data from January till October of 2022 are backtested. However, Consistent Compounders was launched in December of 2018, and hence we've used the actual numbers for that calculation, which is gross of fees and expenses. Now, what does this slide tell us? If you were to invest 50-50 in GCP and CCP from January of 2019 till December of 2023, for this period of 5 years, you would have actually ended up making close to 25% returns, 24.6% returns. But at the same time, again, by adding a 50-50 combination, the volatility, the journey of your investment actually becomes less volatile and hence more smooth. So you add stability to your investment journey. At the same time, you're not compromising on the returns when it comes to doing a 50-50 allocation. Please do note, the 50-50 allocation is for representation here. Every investor could have a different allocation. It could be 60-40, 70-30. But for the sake of representation, we thought how would the numbers look at on a 50-50 basis is what we want to show here. Like I said, that Global Compounders PMS was launched in October of 2022. What we've realized that during this course of 15 months or so, we've been speaking to a lot of clients and partners, and we've realized that there are a couple of fallacies or myths or misconceptions about investing globally. And we thought, let's take up the top 3 out of that list for the benefit of this session today and for our participants. So which are the three most discussed policies that we've come across at Marcellus? The first one stating, I don't need global diversification. India is the best performing stock market. Obviously, we all are equally invested in domestic markets. Many of you are equally invested in our equity portfolios at Marcellus. However, what is the data showing? Now, when we look at the last 20 calendar years for S&P 500 and Nifty 50, the message is very clear. Winners continue to rotate. It is impossible for us to know in which given year, which country market is going to do better and which will not do better. And what we've realized that at least in the last 19-20 years, 50% of the time, S&P 500 has actually delivered a better return than Nifty 50. And hence, if return is the criteria, we believe diversification is the key. Diversification across asset classes, diversification across geographies definitely makes sense here. The second policy that we've been hearing quite often is when it comes to United States, people do say it's a slow growth economy. Do we really need to invest in a slow growth economy like United States? What is the reality? The reality states that high growth GDP does not necessarily ensure high stock market returns. Now, this slide is actually very interesting. We have taken examples of China and Japan as a comparison with United States to draw this inference. From 1992 till 2003, if you look at the GDP growth in dollar terms for US and China, you can see that China has grown significantly faster than United States. The US growth is 4.6%, China's growth is 13.3%. However, surprisingly, if you look at the total stock market returns, again in USD terms, US has actually delivered a better return of 9.7%. Same is the case for Japan, and we are taking long periods of example here. Even if you were to look at Japan from 1972 till 2023, the data equally tells us the same thing. The point that we are trying to drive here is it is not always necessary that high GDP growth will only lead to high stock market returns. The other point to speak about here is that while you are investing in the United States, you are essentially buying companies which are listed in the United States. However, if you were to look at the global compounders portfolio, at least a third of our companies would be getting more than 40% of their revenues from outside of United States. What this tells us is that by investing in the United States, you are essentially investing in the world's growth companies by investing in a combination of global compounders PMS as well as consistent compounders PMS. The third policy that we've heard quite often is that currency depreciation does not impact an investor in India at all. Now we have two ways to look at this. The first is if you have education plans for your kids abroad and you want to send your kids to some of the best universities. Let's assume for the sake of simplicity that in 2022, you plan to send your kids 2 or 3 years hence to some of the best universities in the States. And you realize that you've planned for $100,000 at a rate of 71 rupees. However, in 2023, when you actually have to make those payments, many of us realize that we've missed two important factors. The first factor being the United States education inflation, which is about 10 to 12%. The second factor being that 71 rupees to a dollar has now actually become 82 rupees and your currency has depreciated. Instead of 71 lakh rupees, you actually have to shell out approximately 1.1 crores. So this clearly tells us, while it's important to create INR assets, but if you have dollar liabilities abroad, you will also have to look at creating dollar assets and not only rely on INR assets in India. Now, if you don't have education goals abroad for your kids, which is fair, if you look at the data on the right-hand side, it actually tells us how currency is impacting us almost on a day-to-day basis in India as well. iPhone is a perfect example to show here. right from 2019 till 2022, if you look at the launch price of USD iPhone, the rate has actually remained steady at $799. However, if you look at the India launch price in INR for all these phones in all these years, you see there is a 14% change when it comes to the launch price. For iPhone Pro, I'm sure many of us are using that. The rate of change in INR in launch price is actually pretty stark. Versus if you look at the USD rates, it has actually been steady. And hence, whether we have dollar liabilities abroad or whether we are consuming goods and services from companies which are listed in the United States, currency actually impacts us on a day-to-day basis. And it is prudent to also look at creating dollar assets in addition to INR assets. And we believe Marcellus has the perfect proposition available for you to plan this for yourself. Now, given these three policies, we will dig a little deeper into what Global Compounders portfolio is. We've spent about 15 months of existence on this portfolio. And I would also request participants to start typing their questions in the Q&A box. Once Arindam's session is over, post that we will have Rakshit who will give us an update on consistent compounders PMS. And I will be asking the questions from the Q&A box to the respective fund managers. With that, Arindam, over to you.
Cool, great. Thank you, Hardik. You can hear me okay, right?
Yes.
Great. Hello, everybody. Hello, everybody, for tuning in on a weekend. So taking the cue from what Hardik said just now, investing in global markets, that makes total sense for any Indian investor for the reasons that Hardik explained to us. However, there are a few major problems or roadblocks that an average Indian investor typically faces when they're trying to invest in global stocks. They are basically, it is very hard for accessing high quality fund managers. That is number one. And eventually, even some of the high quality funds, they typically require a minimum amount of, say, at times in the kind of millions of dollars to get invested in. And number three, the taxation at fund level. If you want to invest in some of the foreign funds, at fund level for foreign investment for Indian HNIs or RIs, resident individuals, is actually quite punitive. So that is the reason, I mean, that Indian investors many times miss out on the exceptional wealth creation that Hardik just laid out. So to address those problems, we thought that Marcellus GCP can be a perfect solution for that. So before we get into the product, just let me give you a bit background about myself. So before joining Marcellus, I was working with principal global investors in New York. So I joined Marcellus just after around 2013, just after completing my MBA. So around 2018-19, I started covering emerging markets portfolio. That is when actually I first came in touch with Saurav Mukherjee, who was back then with Ambit. So thereafter, Saurav went to start Marcellus, but we kept in touch throughout this time. So towards the end of 2021, Saurav and I spoke about the need of an active investment vehicle for Indian investors within for Indian investors. So within few months, we are figuring out the logistics, how we should make the product viable, etc. So in the meantime, we met Jaibir, the other gentleman that you see on your screen. So he also showed his interest. So Jaibir was the head of research at Premji Invest, and his interest to build the team actually gave us further confidence to build the product. And in June 2022, I migrated back to India with my family and started the team. So now it is a 5-member team dedicated towards just this product. We tried to keep the product very simple so that it is scalable. So our investment universe is basically North America, large and mid cap, and developed Europe, large and mid cap. So stock selection is a multi-step process, as you can imagine. But broadly, we can classify them into two buckets. The first one is quantitative, and the second one is, of course, qualitative. The quantitative part actually involves multiple filtering criteria to identify stocks that have demonstrated historically consistent good capital allocation while delivering profitable growth throughout multiple business cycles. And the qualitative assessment that involves secondary research, such as reading 15, 20 years of annual reports, broker reports. But the crux, the most important point of the qualitative assessment that you do actually involves the primary channel checks. Where you try to engage with the employees or the ex-employees or industry experts of relevant companies and their entire value chain, basically, to understand the nitty-gritties of the companies that you're looking at. Then this also, of course, involves a lot of site visit. Just to give an idea, during last quarter, our consumer analyst actually visited Costco, which is one of our holdings that we have in our GCP portfolio, in China and Japan to assess the expansion opportunity, especially in China. So we that is the main kind of, I would say, the main crux of the investment process. Now, if you look at the outcome, Hardik, can you go back to the previous slide? Yeah, so if you look at the outcome, so we are basically looking for this 40 to 45 dominant franchises, which are kind of run by exceptional capital allocators. Okay, and if you look at the outcome is actually quite I would say quite interesting. If you look at their free cash flow CAGR or the EPS CAGR for any 5-year rolling window, they're not only consistent than the typical S&P's 7% CAGR EPS CAGR that you can see here, but also they are actually 2 to 3x higher than that of S&P. And this S&P 7% number, that is nothing that we're cherry picking here. So if you look at the 65 years of history of S&P's existence, typically S&P delivers 9 to 10% growth, like shareholder return. 7% comes from 7.5 comes from EPS, and the rest comes from the dividend yield. So broadly, the outcome of the process that I just described to you is actually quite phenomenal, I would say. Consistent, profitable growth, that's what we're looking for. Hardik, can go to the next one. So this is basically a glimpse of the portfolio that we have in place. As I mentioned, it's a 40 to 45 stocks that we cover in totality. Out of that, around 25 to 30 companies that goes into the portfolio. Right now, we have 28 stocks in the portfolio. Now, these are the 9 stocks, as I said, it's just a kind of highlight of some of the companies that we have. So broadly, you can see on the left-hand panel, we have categorized them into 3 broad categories. So the first one is pick and shovel. The second one is utilities, and the third one is consumer. So allocation in companies what you describe in pick and shovel, that is basically the highest allocation that we have, is around 45 to 50% of the portfolio. These are the companies that are not producing the end products, but they are an essential part of the entire value chain. So let me give you an example, which would likely make it more clear. So you can see this company ASML that is listed here in the chart, top left. So ASML makes lithography equipment, so which plays a big part in chip manufacturing. ASML has an 80% market share globally in this vertical. In the most latest version of lithography equipments, they have actually a monopoly, 100% market share. Every sophisticated electronic device that we see in the world has likely a bit of ASML. For example, if you are watching this video in your phone or on a tablet or in your laptop, your machine must be running on some very sophisticated chips. For your reference, I mean, the latest iPhone that uses around the A17 chip that has more than 15 billion transistors actually that goes into it. So ASML make the machines which helps you etch those transistors in the design, circuit design. Extremely difficult process to manufacture that, and that is ASML's excellence, research and development excellence, you can say that. But the beauty of this kind of business is that you are not actually exposed to the risk of any particular customer. So you're not exposed to the risk that, if people are using more and more laptops, or people are using more and more iPads, or people are using more and more phones for data consumption. It doesn't really matter. It also doesn't matter if iPhone is winning market share versus Samsung or vice versa. these companies are kind of a neutral arms dealer in this entire value chain. So whatever you do, if you just consume data, more and more data, you have to use ASML in some form. Okay, so if you think about the opportunity of these companies, like for example, ASML, the data consumption is growing at a high teens CAGR. And ASML kind of companies can compound at low to mid teens. That's what we're expecting for decades to come. Right now, one beauty of pick and shovel that we think is misunderstood as a group is that you actually can find many niche monopoly in that category in these kind of companies, because these are not very huge markets, and these markets need a lot of work to get done before you can be successful. As a result, you will find only one or two companies in the pick and shovel bucket most of the time, and that we believe makes it so attractive. Now, the second broadest category that we have in our portfolio, what we call utility, and if I want to call it more rightly, they are actually modern utilities, which is around, I would say, 25 to 30% of the portfolio. So let me tell you how they are similar, but at the same time, not a bit different also from the traditional utilities, such as gas, water, etc. Now, if you think about the traditional utility business, the beauty of that business is that the cash flows are predictable. And many times, actually, those businesses are regional monopolies. So, for example, in Mumbai, you have one T&D, transmission and distribution player. In Calcutta, you'll find one, right? So one or two. So that's a great kind of positioning, that you have kind of regional monopoly. You can predict your cash flows, but at the same time, the challenge is that the traditional utilities are regulated. So you are not supposed to earn more than a certain return on equity or certain profit margin that the government or the regulatory body basically decides. So that caps the return potential for any investor. When you're operating in a regulated environment, that is typically a challenge. Now, what we have invested in GCP, we are kind of looking for the companies which have similar characteristics in terms of recurring revenue growth, etc., and kind of in the monopolistic positioning, etc. But at the same time, they are not capped by any regulatory body. So these are basically unregulated monopolies which can grow at a sustainable 15% plus CAGR over a long period of time. So one company that you can see here is basically Intuitive Surgical, that fits into this framework pretty well. So Intuitive manufactures Da Vinci surgical robots, which have around 85 to 90% market share in the soft tissue robotic surgery market. Their moats are, again, multifold. The massive amount of clinical data that they have garnered, which basically creates a chicken and egg problem for any new competitors to come in, because you need to produce clinical data to show, but if no one is using their machines, then it's very hard to generate clinical data. That's the first level of moat. But more importantly, I think there are a few other layers of moat that people are not, that are often talked about. Of course, if I layer them in different ways, the kind of attachment, the kind of stickiness that they have built over with the doctors or the surgeons over time, that is very, very hard to replicate. And one of the reason being is that most of the surgeons who are using this, they get in hand on these machines when they are at their medical school. And when they're at medical school, they get in hand on this when they start practicing on their own. They basically want to use this kind of machine. So this is the first layer of moat they have created over time. Similarly, these machines actually elongates the career span of any surgeon. So think about it, after 50, 55, when a surgeon is at the peak of their career, it typically becomes difficult because of age, that they cannot stand for a longer time. Their hand might tremor a bit. But when you're using these machines, these robots, you can actually sit down on a console. You can operate a patient using just the hand movement of some basic things, right? You just need the skill. That's most paramount for this. So basically, you're elongating the lifespan of a doctor. You have built the trust. They have been using it for a long time. So that basically created this enormous moat for Intuitive that helps them to make the market share maintain the market share at around 85 to 90%, which is incredible. Now, if you think about the opportunity for this kind of business, right now, only 5% of the surgeries are done through robots. We think it can go to say 35 to 40% as the cost become less prohibitive for this kind of procedures. That is the upper limit where it can go. So again, as I said, this is unregulated, but kind of a monopoly in their segment. It checked those two boxes. Now, how intuitive, check the third box, which is generating the recurring cash flow. That is also more interesting. So they basically turn this model into a razor blade model. So every intuitive robots that comes, that cost around $2 million each of them. But for each procedure that you perform with these robots, certain instruments need to be replaced, right? So it's basically a classic razor blade. You buy the razor one time, you have to keep on replacing the blade. So that is the recurring stream of cash flow that Intuitive generates. And now that part of the revenue is actually 80% of their total revenue. So again, built a monopoly, built a moat around that, turned the business into a kind of utility kind of cash flow, at the same time maintaining the moat and addressing a huge market. That is typically what you are saying when you are talking about any modern day utilities. That is what we are looking for. So you'll find quite a few in our portfolio. Then the third bucket where you've invested in the portfolio is the consumption part of it. And here, again, if I want to be more specific, we are talking about the premiumization of consumption. So, which is one well-known fact is that the world is getting more polarized. What it means is that the rich people are getting more richer. If we see data, we have seen that the number of dollar millionaires, so the people who are earning more than $1 million every year, that is increasing at a clip of 6 to 7% per year. If you think about the world population growth is around 1 to 2%, that 6 to 7% is actually very juicy. And more importantly, this strata of the population, they are actually less price sensitive, right? So that means that you can actually pass on significant amount of pricing for this kind of customers. And even what makes it, I think, even more interesting investment opportunity, that there are very few companies that are actually catering to the needs of this sort of people. One company that we like a lot is Armis, which makes these expensive handbags catering to the super elites of the world. Again, some of them actually cost in crores, so it is not for everyone, and they wanted to keep it like that. So that is the beauty of the business, and they have been doing it for last 150 plus years. So think about it. Is of course the craft is exceptionally good. The bags are exceptionally good, well designed. But at the same time, what drives the value for an Armis bag is not only the craft that goes behind it, but also the exclusivity or the scarcity, or being in a social strata that matters for a lot of people. So that drives the exponential growth that Armis kind of companies have seen over the decades. So, I mean, just to put you some numbers here, 180 plus years of probably high teens kind of earnings CAGR. That is incredible, and Armis continues to do it, decades after decades. So again, that is the kind of consumption type of investment that we are trying to do in our portfolio. I think next slide. Yeah, so one thing that we have noticed that it is, if we can identify good stock, that is basically 60% of the job done. The challenge that comes is that you have to make sure that the fundamental value compounding is not getting disconnected from the share price compounding. That happens quite a lot. So I mean, the companies that we're talking about, they're all great companies, but at times their valuation goes beyond what you can actually justify. Now, there are of course quite a bit of biases that creeps in when a stock is doing well. What we have tried to do is we built a framework which I have named Torque. So what it tries to do is it tries to figure out at a system level if certain group of stocks is actually running higher than their fundamental value compounding. If that is the case, we try to reallocate, do some repositioning within the portfolio. So again, we are not going down in the quality curve, but suppose we have 28 stocks in the portfolio, we'll find that there are 6, 7 stocks which are more pricier than what we are comfortable with. We take down their prices, take down their weights in the portfolio. At the same time, we kind of jack up the weights of the portfolio companies which we think are undervalued. The reason, again, this is not a phenomena that happens every quarter or every year. It is a once in a kind of 4 or 5 years of phenomena. But if we do that religiously, what I've seen that it adds around 2 to 3 points of alpha over a cycle, over a business cycle. Now to put it together, As I said, like we have a quantitative process, we have qualitative process for stock selection, and finally the portfolio construction. Putting this together, we think that this portfolio can deliver 6 to 9% of gross alpha or additional return over what S&P does over a long period of time. Next slide. Yeah, so I thought it would be relevant to talk about what happened in 2023. So it's actually very unique year. You might have heard about this in the press. I'm sure many of you actually follow the markets. So if you look at the red line, so the red line is basically the S&P 500 return. So as you know, there are just top few stocks actually drove most of it. This kind of shows up the gap between the gray line and the red line. So gray line is basically you take all the stocks that is there in S&P 500 and equally weight them. And the difference is actually meaningful between the red and gray line. And that is driven by the contribution from the big 7 stocks. Like people talk about Meta, Google, Amazon, Apple, Tesla, Nvidia, etc. You can see on the bar on the right side is that the big 7 actually, if you break down the returns of the 25% return that S&P did last year, 16% of that has come from these big 7 stocks. 9% has been contributed by the other stocks. Now, as a result, it was, as I said, it's a very unique year. You can see that the most of the mid and large cap core strategies across the globe who are trying to track S&P 500, they have actually underperformed. But despite that, our GCP portfolio had very limited exposure in the big 7. But given the stock selection and the portfolio construction, we just talked about in previous slides, that actually helped us quite a bit to outperform the S&P by some margin here. Again, if you look at the contribution from the big 7, it's actually very less, only 7.5%, and the other stocks actually contributed more. So basically, the stock selection played out a big role in the performance of our portfolio last year. Next slide, Hardik. Yeah, so again, Hardik mentioned it already. So this is basically the NAV performance since we launched a portfolio 15 months back. Has been doing, it isn't performing the way we have been expecting. Most of the outgrowth that you see versus S&P has been driven by better earnings growth. Valuation has contributed very little. Just to make the expectation right here, so what we're looking for, as I said, 6 to 9% of alpha in a gross level that includes basically tax, etc. So if you take out tax and fees, what you're targeting is 3 to 4 points of excess return, taking out everything over what S&P delivers over a longer period of time. That is the goal. That's how we're trying to run the fund. And when I say 3 to 4% alpha, it is not going to happen every year, but over a business cycle, over a 5-year period, you should get that 3 to 4% of CAGR alpha that we're targeting. So over to you, Hardik.
Great. Thank you, Arindam, for that explanation. So while we've spoken about GCP, we've spoken about the policies regarding to global investing, and we've spoken about the benefits of double engine compounding. We thought it's important that we also tell you how you can go about investing in this offering. And at present, one of the best things that have actually happened is we had started the PMS of Global Compounders PMS via the GIFT City back in October 2022 with a minimum ticket size of $150,000. However, just a few days ago, GIFT City has actually launched the accredited investor norms, which has brought down the minimum ticket size to $25,000. So the minimum ticket size now, I repeat, in the GIFT City PMS is $25,000 if you qualify for the rules of accredited investors as per the GIFT City. Or if you do not qualify for that, then it remains at $150,000. For many of our partners who are on this call today, if you all also have tie-ups with Crystal.ai, our offering is also listed on the Crystal's platform. For our clients as well, this portfolio is available on Crystal's platform with a minimum ticket size of $25,000. However, the difference between the two portfolios on the Crystal GIFT City PMS offering, my apologies, is that that portfolio is only available for US stocks as of now due to some constraints. However, the GIFT City PMS gives you the full exposure of what Arindam has spoken about. We will take up the accredited investor rules if they are there in the Q&A for now. But with this, I also invite Rakshit Ranjan to come forth and speak about the consistent compounders PMS. Rakshit, over to you.
Thank you, Hardik. Thanks, Arindam. Good morning, everyone. Let me take control of the slides first. Right. So I'll talk for a few minutes about the consistent compounders portfolio, how it has performed, what have been the drivers, detractors, and opportunities that lie ahead. So this is the slide highlighting the fundamentals of the stocks in the portfolio. We've got 15 companies in the portfolio. Returns on equity, returns on capital employed have largely remained healthy in the 30 to 35% band throughout the last 5 years. You can see here. Profits have grown consistently at around 18% to 20% over FY19 to 23, the encircled bits in the bottom row. In FY24, the running financial year, the growth in revenues and profits has further accelerated to mid-20s. Barring a couple of companies, all of them have reported the third quarter FY24 numbers as well in the encircled red piece that you see on the slide. Do note that I have excluded in the weighted averages on the bottom line. I have excluded Trent from the computation of the weighted average profit growth rate here, given how significantly the 450% profit after tax growth of Trent would have skewed the weighted average picture. Now, on the broader portfolio, the share price CAGR over the last 2 years has been significantly lagging behind the fundamentals. It's only mid-single digits, and hence there has been a significant derating of PE multiples, or you can say that fundamentals have run significantly ahead of the share prices on the PE ratio. In the next few slides, I'll shed some more light on the degree to which this PE multiple derating is a good news versus a bad news when you analyze it. This is a slide showing a historical trend line of Nifty 50's fundamentals compared to consistent compounders portfolio's fundamentals and Nifty 50's PE multiples compared to consistent compounders portfolio's PE multiples. So let me just take you through how to read the chart on top and the table at the bottom. In the chart on the top, the dotted line shows that the return on equity of CCP has been consistently around 1.5 to 2%, 1.5 to 2 times higher than the ROEs of Nifty 50 companies, right? And the solid line in the chart shows that the premium of PE multiples of CCP over Nifty 50 had expanded gradually from around 1.7 times 10 years ago to around 2.8, 3.5 times pre-COVID. Well, from 2.8 just pre-COVID, it expanded to 3.5 during COVID. And particularly over the last 24 months, the PE premium, CCP PE divided by Nifty PE, it has compressed by as much as 40 to 50%. The current PE multiple premium is almost at a 10-year low. Right, effectively, the compression in PE multiples over the last 2, 3, 4 years has happened without a compression in the quality premium of the portfolio. Quality premium being represented by the dotted line, the dashed line, and the PE multiple premium being represented by the solid line in this chart. Also, just a point to note, in order to remove any aberrations in the EPS, we have used 1-year forward PE multiples using Bloomberg consensus data instead of trailing PE multiples, because trailing PE during the COVID period would have jagged up and down significantly given how big the aberrations were. So 1-year forward PE as on March of every year is what we have taken to plot this chart. Now, there's there's some stock-wise data in this slide of the current CCP portfolio constituents and how their share prices have moved against Bloomberg consensus forward EPS over the last 2 years, which is the left block highlighted in the dotted red triangles. Rectangles, and over the 5-year period, which is the central block, and over the 10-year period, the right side block. Again, we've taken forward EPS here to compute the EPS CAGRs. Broadly speaking, the EPS CAGR of this portfolio has been around 20-23%, pretty consistently over the last decade. But particularly over the last 2 years, there has been a massive disconnect between the EPS CAGRs and share price CAGRs. Share prices have compounded at only mid-single digit run rate, as I previously mentioned, over the last 2 years, compared to around 20% plus run rate of EPS compounding over the same period. Now, what kind of conclusions can be drawn from this comparison between EPS and share prices? There are 3 broad observations around the PE multiple movements of the last 2 years or 5 years. The first observation is that there are 3 examples in the portfolio, 3 out of the 15 stocks in CCP, where there was over-earning in 2021 calendar year, which means prices ran ahead of fundamentals due to COVID-related tailwinds till Jan 2022. And not only could we not foresee the end of COVID, which I'm sure nobody could, but we did not significantly reduce our allocations as PE multiples expanded for these 3 stocks during 2021. And hence, some of the derating of PE multiples for these 3 companies that we've seen over the last 2 years is a reversal of this over-earning. We have offset part of the damage here by increasing allocations when the share prices overcorrected. Some of those benefits have already been accrued to the portfolio returns. More are expected in future. However, this was a very good learning for us. And as we speak, since Jan 2022, we have been very actively changing our allocations to stocks where there are elements of over-earning on an ongoing basis. So that's the first observation. It's a learning on 3 out of the 15 stocks. Here comes the second observation. So I'll take some examples here. So take, for instance, HDFC Bank as an example. 5 years ago, its forward PE multiple was 24 times. 2 years ago, the forward PE multiple dropped down to 19 times, 19. And today, it has further dropped down to 15 times. This PE multiple is at a 15-year low for HDFC Bank. Now, the EPS CAGR has consistently been around 18 to 20% over the last 15 years entirety, right? We are convinced about the management quality here, even after Aditya Puri has left. We are also convinced about the strengths of its liabilities franchise, technology-related upgrades that this bank has made over the last 3 years, and the degree of credit discipline and operational efficiencies that this bank has. And hence, despite in fact, I would say amidst the short-term headwinds to its deposits franchise, which were reported in the last quarter, we are treating the PE multiple compression as an opportunity to benefit from. Right, this is unlike the first example where there was over-earning and a reversal of that, which is not as significant an opportunity as the observation 2 is. And there's another example of observation 2 here. Let's say Dr. Lal Path Labs. Today, consensus expects only 10 or 11% revenue growth and profit compounding of this franchise, because the last 2 years has been around the 10 to 15% revenue growth number for non-COVID revenues. And competition from online players is already receding. Wellness diagnostics as a category is growing rapidly in the aftermath of COVID. Dr. Lal has become a far better variant on D2C businesses in the diagnostic space than it previously was. And hence, we believe the last 2 years of muted revenue growth, which are being fed into the market's perception for the future, is an opportunity to benefit from. That's a different variant versus HDFC Bank of the observation 2, which is an opportunity, and hence we are position sizing it accordingly. There's a third observation as well from the PE multiple movement. Now this is an interesting one. So the observation 3 mentioned on the slide is where prices have run a little ahead of fundamentals over the last 5 years, but it is not over earning. For instance, you can go back to, let's say, this table. Stocks 12 and 13 are Titan and Trent. 7 years ago, Titan and Trent used to trade at 25 to 30 times PE multiples. At that time, Titan was not generating any meaningful revenues or profits beyond Tanishq. And Tanishq was all about non-wedding jewelry. Over the last 7 years, Titan's business model has gone through a radical upgrade. Wedding jewelry has become a very successful and large aspect, more than a quarter of Tanishq. CaratLane has gotten added to it. Watches and wearables has become a very fast-growing segment of Titan, with improving profitability progressively. Eyewear has become profitable from loss-making over the last 5 years. And there's a successful incubation of new formats such as the Naira as a retailer of sarees, for instance. Right? Similarly, Trent 5 years ago, 7 years ago, was all about West Side, with several other formats yet to stabilize. And today, Trent is a wider and a deeper business with scale achieved in Zudio, with success achieved, or I would say success on the horizon for Star Bazaar as a scaled up profitable format, and several new formats being put in the incubator. It has become a platform of retail formats from being a single apparel retailer under West Side. And when both of these companies traded at 25 to 30 times PE multiple 6, 7 years ago, they were very different businesses than what they are today. Today, when they trade at more than 50, 60 times PE, they are multi-format retail platforms, more than one industries, larger canvas, and hence significantly long runway for growth as well. As a result, a large part of the PE expansion that you see for stocks 12 and 13 here, for the last 5 years, the PE multiple expansion of, I think, 10 to 13% that you see, it is not over-earning. It is, in fact, a reflection of an upgrade in the market's perception of the quality of these businesses. So those are 3 different types of observations of how PE multiples have moved. And hence, there are some learnings, some opportunities, and some clarity of thought needed when you look at some of the PE multiple changes. Now, many of you ask us what kind of changes have we made to our portfolio construction approach over the last 2-3 years. There are 3 broad categories. The first piece is addition of new stocks. Trent and Astral got added in the last 6-7 months, for instance, because their businesses evolved and our conviction levels on the evolving businesses increased. Second type of change is the rebalancing benefits from over-earning and under-earnings. Just to quantify, until Jan 2022, rebalancing used to add less than 1% to annualized return of CCP, and now rebalancing actions have added, depending on which 12-month rolling period you take over the last 2 years, rebalancing has added anywhere between 2.5% to 4% to the annualized return of CCP. And the third kind of change is benefiting from threats of competition and disruption, which the market is perceiving as a bigger risk than what we think exists. And hence, the unjustified bearishness in some of those stocks is an opportunity we are trying to benefit from. These are some of the examples of changes we made to position sizes in CCP in 2022 and 23. Most of them have added significant value, as I quantified, to portfolio returns over the last 2 years. There's a lot of catch up to be done. I can already see some of the early questions in the Q&A box were about how soon do we expect CCP performance to hit the long-term guided range. So the long-term guided range remains 18 to 20%. We have been 2 to 3% below that for the last 5 years. Last 3 years has been even lower, and it's largely because of the kind of aberrations that we've seen in the last 2 years. We see a catch-up. Catch-up is underway. Some of it has happened in financial year FY24 in the last 9-10 months. You can see in your portfolios. We see more of it going forward, particularly when you look at this PE premium, the red line on top, the degree to which it has come down despite some of the re-rating of, say, a Titan or a Trent in the portfolio, as I said, not being over-earning. You adjust for that, the PE premium is even lower, etc. That is a catch-up that we are waiting to see. Hard to put a timeline, whether it will be 6 months or 12 months, but over the next couple of years, we do see performance sort of reversing from what it has been in the last couple of years. So I'll stop here and hand it back to Hardik for the next section of the webinar.
Good. Thank you, Rakshit. Since you were sharing the screens, I thought we'll first take up the questions from the Q&A box pertaining to consistent compounders, PMS, and domestic offerings. Post that, we also have a few questions in the Q&A box for Arindam and Jabir. So some of the questions are around the stock-specific, stocks which are part of our consistent compounders portfolio, particularly towards the BFSI piece in the portfolio. While you've covered HDFC Bank already, there are questions with regards to why HDFC Life has continued to remain a part of the portfolio, despite the stock has not done much well, at least for a better part of 2 years now. Your views on that, Rakshit?
Sure. So the top 5 stocks that you see here are the financials. Stock number 5 is HDFC Life on this screen. Now, first of all, when you look at the EPS compounding here, right, for all the financials, it has been a very healthy compounding for the last 5 years, 3 years, and 3 out of the 5 financial stocks were listed for longer than 5 years. For them, the 10-year numbers are also available for Bajaj Finance, HDFC Bank, and Kotak, the top 3 in this list. There is no weakness in the fundamentals compounding that has been reported to begin with. Second piece, is the future going to be weaker than the past? So when you look at how the regulatory environment is evolving in the life insurance space, how the awareness and penetration of insurance as a category is looking to accelerate going forward. We've already seen a massive expansion in health insurance, for instance, which obviously forms part of more ICICI Lombard, I would say, rather than HDFC Life. But in general, the degree of under-penetration of, let's say, protection products and term plans, annuities, etc., in the country, there's a massive opportunity to grow here. When you compare the competitive landscape, underwriting is where HDFC Life is head and shoulders above anyone else. Tech investments and operational efficiencies is where it is head and shoulders above anyone else. In terms of the sales muscle, sales engine, prior to the HDFC Bank acquisition of HDFC Limited or merger of HDFC Limited, prior to that transaction, HDFC Life sales muscle could have been considered to be slightly weaker given how SBI Life gets the benefit of State Bank of India branches, etc. But after the merger, this is also an area which has become significant strength as HDFC Bank uses HDFC Life cross-sell to its existing customers going forward. When you look at that in terms of the broader opportunity size and the strength of the franchise, combine the two together, there is massive opportunity to to benefit from the upside of HDFC Life here. And hence, we stay invested. Questions like, is HDFC Life going to compound at a healthy rate or not, were raised even when last year's budget called curtain. I mean, it appeared that there are curtains on a large part of the HDFC Life portfolio with the more than 5 lakh policies and the way tax slabs are changing in direct taxation, etc. But we've seen the outcome of that in the last 4 quarters. The financials reported for HDFC Life have been incredibly healthy on annual premium equivalent growth and profitability as well. So that's on HDFC Life, but in general, for HDFC Bank, for instance, yes, deposits in the last quarter were a concern. Maybe for one more quarter, deposits might be a concern. Loan growth has not been a concern, and this deposits concern is only transient, temporary, given the liquidity conditions of the market and the timing of the HDFC Bank and Limited merger. It is not reflective of weakness relative to competition of HDFC Bank's liabilities franchise. In fact, HDFC Bank's liabilities franchise has become even stronger after the merger, and it remains the strongest compared to any other bank in the ecosystem. And hence, as I was previously mentioned, the kind of under-earning that you see of HDFC Bank. HDFC Bank in this table is stock number 3. The degree of under-earning of 12% in the last 2 years, 8% over the last 5 years, and minus 5%, as in 5% under-earning in the last 10 years. It's a massive opportunity to benefit from. You won't get the lending industry being as benign a credit environment as it has been in the last 1 or 2 years. And hence, when it goes through its own cycles, you will see the outperformance of the quality of the franchise here. Last quarter's numbers were a transient blip, I would say, in the longer scheme of things. So yeah, so top 5 are financials. In fact, they are part of opportunity number 2 that we're trying to benefit from.
Sure. Rakshit, there are a few more stock-specific questions. There are questions around Dr. Lal and the growth prospects around the company. Also in terms of what kind of external checks we run to ensure if this continues to remain a growth company and deserving to be part of consistent compounders portfolio.
Yes. So, I mean, this is an interesting one, Dr. Lal, given the amount of work we've done in the last 1.5 years, due to so many dynamics that are evolving here. And hence I can go on and on, but let me summarize. First and foremost, there are 2 very different types of diagnostics. One is illness related, one is wellness related. Historically, 90% of the industry has been illness oriented, where a doctor is involved and the doctor needs to be convinced about the diagnostic report before he or she puts their name behind the treatment that they are prescribing, and their reputation at stake behind the treatment basis the diagnostic report. Right. This is where in the illness space, there were attempts made by several new entrants, particularly private equity, venture capital funded players. Those attempts were futile. Many of the doctors, they didn't believe, given the kind of cost, capital burn related customer acquisition that these companies were pursuing. There were compromises on quality for many of them. Medical fraternity, as a result, kept going back to the 3 to 5 incumbent traditional sort of business models with owned labs, with reputation of quality, etc. So that competition in illness is out of the way. When it comes to wellness, which used to be 10% of the entire industry, it's becoming a bigger size. Dr. Lal's Swasth Fit packages are at the fastest growing pace. They are the largest by revenue, and they are also the ones gaining market share compared to the wellness packages of either other listed players or wellness packages of even the new entrants. New entrants were making presence in the wellness space until about 8 to 10 months ago. Over the last 8 to 10 months, there's been a significant decline in competitive intensity here. So that's one aspect of the industry. The second aspect is the demand side. From a demand side, at one level, COVID has led to customers becoming very self-aware, the households becoming very self-aware about the need for diagnostics to keep a check on their health. The number of people doing wellness testing without being prompted by any doctor or without being prompted by any symptoms, it has shot up significantly in a structural way after COVID. So that's one piece of the demand side. Insurance has led to Mediclaim and all has led to corporate hospitals taking control of IPD patients as in the admitted patients in hospitals. Corporate hospitals are gaining share over nursing homes. Smaller nursing homes previously used to outsource way more testing to the pan-India diagnostic chains than the corporate hospitals do. Corporate hospitals, when they do IPD, they use in-house diagnostics, and only for very rare super specialized tests, they would outsource to a Dr. Lal or the likes of that. So that is the second trend, but that's a reasonably small part of Dr. Lal's revenues, of even many other listed companies' revenues, which is IPD. When it comes to OPD, even within hospitals, we have seen the OPD footfall of hospitals is experiencing diagnostic testing being run by national chains in a bigger proportion now than pre-COVID. And the reason for this is, again, the corporate hospital OPD diagnostics price points are roughly twice to thrice that of, let's say, a Dr. Lal's price points. And hence, the customers are taking the prescriptions from the doctors when it comes to OPD, not IPD. OPD, and they are going back, and for convenience perspective and low pricing, they're getting themselves tested at a nearby Dr. Lal rather than going for the corporate hospital in-house diagnostics. So that's a second very different trend, in fact, in favor of national chains. And then there's the OPD, which is on the high street, that is neither getting insured nor shutting down in a meaningful way. The insurance piece is not going to take control of OPD expenditure in a big way, and the insurance companies themselves, they don't see how to keep a check on malpractices in case they try to do OPD insurance. So it's just a tagline that we do OPD insurance. Less than 1% of healthcare insurance is in OPD, etc. So those are some of the other pieces. Now, when you put all of this together, in a country with healthcare and diagnostic penetration as low as what it currently is, as awareness and affordability rises, the diagnostic industry is not going to grow at 8 or 9 or 7 or 6% CAGR. It will grow at low double digits CAGR at the very least. On top of it, we've got market share gains from Dr. Lal. There is nobody growing faster than Dr. Lal over either the last 1 year, 3 years, 5 years, either in the listed space or even when you look at some of the unlisted players, barring some of the startups which came up in the initial few years. They reported higher CAGRs and now they are moderating. So there's no one growing faster than Dr. Lal, industry growth of low teens. And on top, you apply market share gain upside. There's geographical expansion here, which is another layer of extra points added to the CAGR. And finally, this is a highly cash generative business. Dr. Lal's return on invested capital is more than 80-90%. And hence, it's a massive cash generating engine. That cash, even if it gets paid out as dividends fully, right? So all the accumulated cash also goes out as special dividends, let's say once in 5 years. That itself will add a couple of points to the total shareholder return. If it doesn't get paid out and does get used for acquisitions, in future, the quality of the franchise that this is, it might actually deliver more than say cost of capital on that excess cash generating, adding more than a couple of percentage points to the total shareholder return. So a little long answer to your question, but you're very convinced here. And as I said, it's a massive opportunity when the market is factoring in only 10-11% revenue and profit after tax growth for the foreseeable future of this business versus how we perceive it to be.
Perfect. Thank you, Rakshit. Now, you spoke about some of the learnings and the opportunities that we see from here. However, there are a few questions with regards to how are we going to look at these portfolios from now? Is there a change of stance? Is that what we are trying to speak about? Are we going to look at valuations in a different way? There are a couple of questions around how are we going to look at P multiples or valuations in portfolio construction process. So it'll be great if you could highlight your views on that as well.
Yeah, sure. So let me break it into parts. Part one, are we going to compromise on the quality of the businesses that we invest in only to get some extra return, possibly, hopefully, in the hope of getting some extra return over the next 6 or 12 months? No, we will not do that, because it's a very dangerous game to play. I mean, so take, for instance, the example of the lenders. If we don't see alignment of interest of the largest shareholder of a bank compared to minority shareholders, as in if the largest shareholder is more trying to look after the broader economy, and minority shareholders are at a disadvantage when the corporates, let's say NPAs and credit quality and loan growth, etc., is not top notch. The leverage in some of these lenders, where some of the lenders whose share prices have done very well, the leverage is 20 times, 21 times, 22 times. At that kind of a leverage, taking risk on drop of quality is actually, it might even be fatal, if not significantly decimation of your expected return. So we'll not take the quality compromise route just to sort of give every year better than the market return. We'll try to do better than market by sticking to quality as much as we can do. Coming to the second point on valuations, so there are changes which I mentioned. The type 1 mistake in effect is over-earning is a valuation-oriented learning. And there are type 3s as well, where we invested in Titan and Trent at certain valuations which would have also been considered on the face of it quote-unquote expensive, but the earnings compounding was of a different trajectory. So yes, there are learnings. Yes, there are improvements that we have made. It has already added, as I mentioned, the rebalancing activity has added 2.5 to 4% to the annualized return in the last 2 years. We expect similar or more from these kinds of sort of upgrades that we've made to the portfolio. We'll keep sticking to quality. We'll stay patient and disciplined as long as we haven't invested in companies where neither the earnings are growing nor the share price is growing, right? Then we should be all right. So just to give you a simple example, let's say there are many FMCG companies, right? Some of the large ones as well, where over the last 2 years, 5 years, 7 years, earnings compounding itself is less than 10%, right? There, it's a bigger concern if the share price doesn't move, obviously. But if the earnings compounding of our portfolio remains 20% plus, right, then in the long run, is the earnings compounding which will define the movement of the share prices, not so much the valuation for companies with intended holding periods of the investor being long, right? And that's the point which is worth picking up on this philosophy. We'll stick to that. So yes, there are upgrades and learnings. 3 of them I highlighted with examples.
Perfect. In fact,
Yeah.
Sure. So in the same lines, Rakshit, there's a question with regards to the themes which have done well in the last 2 years. We saw infrastructure, defense, railways, green energy, many of these themes which have done well in the last 1.5, 2 years. There are a few questions around, do some of these companies fit into the framework of CCP or Marcellus? Will they fit into the scheme of how we look at portfolio management? And while we may not continue to hold many of these companies given our filters, how do we ensure that our portfolios outperform when these kind of themes do better?
Right. So look, it's not the thematic investing which makes money for most of Marcellus's Indian equities portfolios. It's the bottom up stock picking which makes money. So as long as the bottom up stock picking discipline exists in the themes that you're talking about, yes, they will be part of Marcellus. They are already part of Marcellus's coverage universe. Some of them have been added to a few of our other portfolios from these spaces. But if it's a theme doing well without the companies underlying it reflecting significant moats or returns on capital employed, then chasing share prices basis the theme without bottom-up discipline of stock picking is something that we'll not do. I hope that answers. So, for instance, we've always been in the last 5 years, we've taken lots of examples of telecom industry, aviation industry, etc. Those are also themes. Similarly, if the bottom up returns on capital employed are not great on some of the themes that you mentioned, Hardik,
Yeah.
then we'll stay away.
Sure. Okay. There are also questions around Asian Paints and the concept of beautiful home services. The question is regarding how that part of business is panning out, and do we feel that that will continue to be a significant part of the earnings for Asian Paints going forward?
Sure. So Asian Paints is stock number 10 here. You can see how the earnings compounding has panned out. 18% 2 years, 17% 5 years, 18% 10 years. This is Asian Paints for you, stock number 10. So there's nothing which you can call as weak historical EPS CAGRs for Asian Paints. In terms of how this business is evolving, so 5 years ago, it was only paints, and then they started growing outside of paints. Outside of paints initially was products used by the same contractors with different applicators. So from a painter within a contractor's purview, moving to a, let's say, mason, carpenter, etc. Right? So construction chemicals, primers, putty, that's what I'm talking about. That was the first phase. The second phase was using those products, expanding the distribution channel, and even breaking into many cement dealerships. And no wonder you see one of the larger cement companies now trying to come into paints. So that was the second piece, distribution expansion, using the product expansion that already had happened. The third piece is going more direct to the customer, and rather than the contractor, moving to the architect. Architect is a completely untapped part of home decor in home building materials in India at the moment. It's totally fragmented. There is very limited, call it organized presence, as in you do have several individual architects. You don't have an institutional architect community in its offering. And hence it becomes quite an ad hoc, unorganized experience for the end customer. To a great extent, below a certain ticket size, so let's say below, say, 20 lakhs of renovation cost on a house, taking it as for example, you won't even appoint an architect. Below 10 lakhs, probably never. Right? So there is massive underpenetration of the service here as well. That is what Asian Paints is trying to capture. Asian Paints is not trying to become the architect themselves in its entirety, although that is also small part of the offering. but they are helping the architect community get more organized, get more sort of value added to the end customer. That is the end agenda. The canvas size here is at least 8 to 10 times the size of the paint industry, right? So think about the amount of money you pay for paint products in a home renovation project. It's a very, very small part of the entire renovation project. From there, getting into other products and then maybe even being able to influence the services aspect and making some money out of it is the broad picture of home decor experiment that Asian Paints has been doing. When you look at the discipline, there are areas where they needed to learn the correct format, which is moated and makes money. They waited for the learning experience on a sleek or bathroom fittings to get crystallized before trying to expand, right? So the discipline of capital allocation here is there. They are not going to make home decor 20, 30, 40% of Asian Paints' revenue within 2 years. It's a sort of journey which has a very big longevity aspect to it, a huge potential, and from I think 4% current revenue, they're targeting 8 to 10% of revenue contribution from home decor by FY26 end, if I'm correct. It's a reasonably fast growth, already a break-even to profitable venture for Asian Paints. And most importantly, it cements its presence in the existing part of the portfolio. To top it up, they are doing backward integration to ensure that value additions on the overall product and services part of Asian Paints, it only enhances. So backward integration of paint manufacturing, backward integration of putty manufacturing with white cement, etc. It'll add to the margins and the moat. So that's how we see the business evolving, keeping a close watch on how things evolve as Grasim enters. It's very interesting. The feedback we are getting from the dealers is very, very interesting. And we are watching it very closely. In the next few months, it'll start becoming very clear.
Slightly again on the same lines. One of the question is that we have a few stocks in the building materials space in the consistent compounders portfolio, likes of Asian Paints, to extent Pidilite and Astral. Most of these companies are entering into each other's businesses, trying to diversify. How do you see this space over the next 3 to 5 years?
Yeah. So stocks 14 and 15 are Pidilite again, Pidilite and Astral respectively, 14 and 15. Yeah. You can compare the performance of stock 10 with 14 and 15 in this slide and see how EPS CAGRs are not cannibalizing each other in a very interesting manner, right? So ऐसा नहीं है कि Asian Paints 17-18% is coming because Pidilite has given up on earnings compounding. Pidilite is also compounding. What's happening here is renovation cycles are crunching, and hence industry size is growing at a very healthy rate in general. So renovation cycles are crunching more because of added convenience and affordability. Previously, getting a house renovated probably meant you can't live in the house when you're undergoing even a small type of renovation. Now, with added convenience, the renovation cycles are crunching, painting cycles, so on and so forth. That's adding to the growth of the industry. The second is unorg to org. In many areas, unorganized is at least 30-40%, in some cases 50-60%. There's a massive upgrade to product quality as well. So for instance, to give you a simple example of construction chemicals, so tile adhesive previously used to be cement. To put a tile on a wall or on the floor, you used to apply a layer of cement underneath. Now you've got the construction chemicals replacing cement, and hence ROF and laticrate and all of these have started to come up, right? So the product innovation is also adding meaningfully to the growth of this industry. And as I said, in general, I think with affordability, convenience, the industry growing, there are opportunities that An Astral and a Pidilite can together capitalize on in adhesives. Pidilite and Asian can together capitalize on in construction chemicals, so on and so forth. Having said that, in the last 5 years, our exposure to home building materials has reduced from about 30% to mid-teens today. And we'll keep making those opportunistic changes wherever we see opportunities to increase it again or reduce it to make better outcomes for our overall portfolio.
Sure. Rakshit, we have two interesting questions. One is, how is the research team built under you for the consistent compounders portfolio? What's the breakup of the team? And for you and the team as a whole, how do you remain sane and stay away from the temptation of the fact that most of the portfolio companies have not done well from a share price perspective, and you're still sticking to your approach of quality?
Right. So the way the team works is, like Arindam mentioned, the GCP team is 5 people working only on global stocks. For the domestic side, similarly, there's a separate team working only on domestic stocks. It's a team strength of 12 analysts at the moment, and we are reasonably staffed there. So 12 analysts and 3 fund managers, which is me, Ashwin, and Tej. That's the broad construct. All the 12 analysts work on sectors which feed into all the 3 fund managers. So it's not that the research team of CCP is separate from the research team of LCP. That is not the case. Domestic equities, it's a common research team. So that's the construct. How do we stick to the discipline under this construct? So one piece is extensive ground level checks. So for instance, many of you might remember back in May 2022, when the intensity in diagnostics of Radcliffe, Healthy, and Startup 1mg, PharmEasy, when that intensity of new competition was at its peak, the kind of ground level checks that we did told us that this is clearly not sustainable, and hence we increased the position in Dr. Lal meaningfully at around 1800, 1900 rupees a share, etc. So those checks are very important. Otherwise, you will always fall into the narrative and sway with emotions or the narrative or the recently reported numbers, which might have a massive aberration vis-a-vis long-term future expectations. So ground level checks is the biggest way to stay alive and awake to the realities. The second piece is a massive challenger kind of construct internally. So whether it be our sales colleagues trying to challenge some of our views, whether it be research analysts who are incentivized actually as part of their incentive structures to create challengers, or whether it be the fund manager asking the research analysts to help the fund manager stay close to the ground, the way the research analyst has been close to the ground, in order to be a double check on the understanding of the situation, and hence transferring of conviction levels from the analyst to the fund manager. There are several of those processes in place to ensure that just because the share price isn't performing, or just because the share price is performing, we don't get carried up and down in our conviction levels on fundamentals. In the long run, this becomes the biggest differentiator for performance of a portfolio, we believe. So that's how we work.
Sure. So before we move on to Arindam, and there are some GIFT City related questions, Rakshit, there are quite a few stock specific questions. The ones which are most asked about are Page Industries, Kotak Mahindra Bank. So at least if you could just give a quick 2-minute brief on each, post that we'll move to Arindam for the Q&A on GIFT City.
Right. So on Page, to begin with, there is no challenge from competition. There are various ways to understand listed as well as unlisted. So just go to the MCA website. We've done that. And you can see till FY23 end financials of all unlisted players in innerwear as well. There is not any single company, no Triumph, no NMR, and there is a lot of buzz that Triumph is probably expanding at a faster pace. There's private equity funding, etc., etc. But numbers speak for themselves. There's nobody growing at a faster pace than Page. That's the first point. Having said that, we are not happy with the rate at which Page's revenues have grown in the last couple of years. There are aberrations related to company-specific pieces like destocking of the channel after ARS. There are aspects related to COVID-related sort of reversal of athleisure demand after work from home got replaced by work from office over the last 12 to 18 months. So there are some of those aspects you need to adjust for that. We have done it. There are a few areas where internally Page has undergone a few management changes, some good, some we are keeping a watch on. There's a massive expansion of the product portfolio, availability of products, and this is a very interesting check that, in fact, listeners on this call can do. About 1.5 years ago, if you were looking for particularly women's innerwear, right? Women's innerwear is a very vast SKU collection compared to men's innerwear, which is far more standardized. In women's innerwear, unavailability, stockouts has always been a massive challenge for every player in the industry, including Page, till about a year and a half ago. Today, you don't see that. It's a significant upgrade to the value add to the end customer if the stockouts can be reduced. The benefits of ARS at a ground level, we can see very, very minimal complaints from the channel and several people supporting the technology upgrades. We've spoken to many vendors who work with Page as tech partners, and they have validated the evolution of Page's mindset on the technology front, so on and so forth. So there's a lot going underneath in terms of fundamentals rather than looking at just the share price. And yes, and hence we are hanging on to our conviction levels here. Kotak Mahindra Bank, I mean, barring Uday Kotak stepping down, there isn't anything that really has changed here. They don't even have the deposits challenge that HDFC Bank reflected in the last one quarter. For HDFC, it's the merger with HDFC Limited, as I mentioned, and the timing, given the liquidity issues of the broader banking sector. So Kotak Mahindra Bank, we don't see many challenges. In fact, in one of the other slides you might have seen, we highlighted we've increased some allocations to Kotak more recently. So yeah, so I'll stop there.
Thank you, Rakshit. Thank you for patiently answering all the questions. We really appreciate that. I'll move over to Arindam and Jabir for some questions which are with regards to global compounders. So Arindam, we spoke about valuations in CCP context and domestic investment. From a global investment perspective, there is a question that many of the companies that you spoke about on that slide of pick and shovel, most of these companies are well recognized by the markets and they would be probably trading at higher multiples. So how do you ensure you take care of the valuations in global compounders portfolio? Yeah, Arindam, over to you.
Yeah, that's a great question. So there are two ways that we look at it. So one is the most important thing is relative valuation. So when I say relative valuation, I'm talking about why the company is trading on relative P, for example, or relative EV/EBITDA, whichever is relevant for that particular company. And if that is meaningfully changing, that kind of raises an alarm. That if how much of that is actually justified. Now, again, so for example, as I said, if I look at the portfolio relative EV/EBITDA valuation back in 2019, I just take the same portfolio. We do the weighted average of EV/EBITDA relative to the market, relative to S&P 500. So it was around 1.5 or 1.6 times back then. It is still the same. So for few stock, of course, they have re-rated. We try to play that, adjusting the weights. But on a portfolio level also, we try to monitor like how far we are from where it used to be. So far that has not been the case, but we keep it tapped, and that is where the torque tool that we talked about that comes handy. So if that stuff is happening for certain stocks going too much and we are overweight on those, We try to make sure that we are pulling the portfolio back to its normal level, where we think is actually relatively normal, by adjusting the weights of the companies that we have in the portfolio. And it's a mix of expensive and not so expensive stock in the portfolio. So that helps us to keep the balance.
Okay. There's also a particular question on a stock specific one on Ashtead Group. If either you or Jabir would speak about the company and the moats around that business.
Yeah, so for the uninitiated, Ashtead is basically an equipment rental company. It is listed in UK, but it is actually an US. It's primarily 95% of its business is in the US. Mostly it started in the southern belt of US. So basically Miami, Texas, that part. Now talking about the moat is actually very simplistically put, the moat is basically scale. So when you're equipment rental, you have to, if you reach a certain scale, then it helps you to negotiate the buying price of the equipment from the OEMs, the original equipment manufacturers. Now, the question might come that why Ashtead, like why not many other companies did that? So there are basically two companies in US. One is United Rental, which is the largest. I think they have 18% market share. Ashtead has around 14. Why no one else come in? Not any large player came in. The reason is very simple. I mean, many of these capital intensive businesses, which doesn't have a huge target addressable market, they typically doesn't attract that much of capital. It is a dirty business to start with. I mean, we have seen that kind of business in many other sectors. So for example, I'll tell you garbage collection, right? So for like in India, municipality does a lot of those, like collect the garbage from our households or the business premises. Same happens in US also, but there is a huge private run businesses which are not basically municipal. So garbage collection is also a very attractive business, but it is a dirty business. It's a capital intensive business where you have to maintain a lot of trucks, you have to fill landfills, etc. So there are not many, there are not many people who wanted to do that or consolidate that industry. So that industry remained like very fragmented for a long period of time before people actually understood the value of those. So if you look at the waste management industry in US, it's actually huge now, consolidated, run by like 5 or 6 companies. Same is happening with the equipment rental. 20, 30 years back, 30 years back when Ashtead started, there are not many doing that, right? So building this kind of equipment rental, very tiny business at that point of time. But once they gained scale towards mid 2000, that is when it started to gain scale, they could actually buy the equipment from the OEMs at 30-35% cheaper prices compared to the MRP listing. And it was also 15-20% lower than the average mom and pop kind of equipment rental business can buy at. So there's a huge delta. So that 15%, if you buy an equipment at that lower price, that gives an incremental ROIC of say 20% or so, 20-25%. So basically, Ashtead and United Rentals, they have been killing the smaller players. Ashtead is killing it like, they're more organically growing. United Rentals is more acquisitive, but we like Ashtead because they're organically growing it because there's a certain advantage above the mom and pop. So that is how they built the moat. And with time, with scale, you gain significant other things together, right? So for example, if you're buying a machine, and US actually is kind of, this model is not doable in smaller countries like say UK or Dubai or kind of UAE, because utilization of your machine matters a lot. And that is why small time contractors, they find it hard to buy an equipment, because if you're not using your machines, then they're basically, eating your money, sitting there doing nothing. But if you are an Ashtead, and if you have a kind of tech backdrop, like you can operate your machine, like you can actually move around your machine from different cities in the US, that gives you huge strategic advantage. So for example, if you're in Houston, you need a machine at Austin. If the machine is not utilized in Houston, you can actually do that. You can see it on your app. So it is doable. So the countries where you have multiple cities, like 300, 400 cities, which are developing together, you can actually utilize your machines in a very strategic manner. The supply chain supremacy actually can create a good story. And that's exactly these top 2 players have done. Right. So that is how the moat is built. Very, very hard to build because, the third largest player is actually, as I said, like their discounting level, that the discount that they get from the OEMs is much lower. It just makes them very hard. You have to take losses for years right? So to get competitive. So it is very hard to catch up. So these two guys kind of, they continue to dominate, grew at a very healthy 15-16% CAGR if you look at like last 10-15 years. And if you remember, like last 10-15 years have been not that great for US industrial or construction activity, right? Post GFC, but still these guys could do very well. So that kind of tells you how strong this business have positioned themselves for a long time.
Okay. Thank you. So there's one more question which speaks about the generative AI and its impact on how we look at stock selection in our GCP portfolio. There are a few companies which are mentioned here that they are well-placed companies like Salesforce or ServiceNow. Do you have an opinion on that?
I'll pick that one up. So
Sure.
on generative AI, so apologies in advance. I'll run a little long. So on generative AI, we're quite optimistic that over 5 years there's going to be a lot of adoption of this technology in a lot of different areas. What we are less confident of is picking technology winners. And when I say technology winners, if you're going to ask me who will have the best Gen AI model 2 years from now, I have no real way of predicting that. Right? So to the extent possible, we want to abstract away technology risk while investing in this space or while trying to benefit from this theme. So we do that in two different ways. So the first is by looking for neutral arms dealers. Now, neutral arms dealers in this case are semiconductor equipment manufacturers. Right? One of the side effects of this Gen AI wave is that there is a massive boom in demand for a particular type of memory. It's called high bandwidth memory or HBM. Now, memory companies are deeply cyclical, so we ideally don't want to own them. However, HBM memory particularly needs really sophisticated tools. One of those really sophisticated tools is an EUV machine, which has a single supplier in the world, which is ASML. So that way, there are other parts of the semiconductor ecosystem, whether foundries or whether parts or whether equipment suppliers, which we can see that, okay, irrespective of which technology wins, these companies will benefit. And I think that stops at NVIDIA. Right? NVIDIA is sort of on the borderline where, given the moat they have around CUDA, given some of the capabilities that they have around networking, you can make a case that they will stay a monopoly, but you can equally make a case that if every other major company in the world is coming after you, you might not remain a monopoly. That's sort of where it stops. The moment you go below that, picking a technology winner is, at least from our point of view, something we can't do. Now, at the other extreme, we want companies which have really strong enterprise businesses, because enterprises will, over a 5-year period, adopt this. Now, this can come either in the form of cloud providers, so we own Amazon or Microsoft, or it can come from companies which are really good enterprise sales teams who have really deep understandings of what enterprises need in terms of technology. Right? So there again, Microsoft would be top of the list. And some of the names you mentioned, Salesforce, ServiceNow would again be companies to consider. Amongst these, our preferences towards Microsoft, we've looked at Salesforce, looked at ServiceNow a couple of times. Frankly, we're a little uncomfortable with the valuation. That's why we don't own it. Salesforce is something which I've not yet done that much work on. It's on the list. At some point in the next few months, we will spend some more time on it. Their capital allocation track record is a bit checkered. Whether we can get comfort on that is one question to answer. But these, Microsoft's sales team, Salesforce's sales team, or ServiceNow sales team, they're all equally good. They're all very capable at understanding what enterprises need and hence building Gen AI enabled tools for them. I'll stop there. Arindam, anything you want to add?
No, I think you covered it well. So it kind of fits into our pick and shovel and utility kind of narrative. So we're playing it through that rather than playing through a kind of pure play, basically.
Okay. You also mentioned about Berkshire Hathaway in that slide, and it's part of our portfolio. Given this has been a frequently asked question as well, given the demise of Charlie Munger and Warren Buffett and the age, is there a way in which you look at this stock from here?
Yeah, that's a great question, and we are actually still thinking through it. I mean, of course, the age was a concern when you took a position in it. There are certain reasons that we like it. Like of course the capital allocation track record, etc., are like wonderful. But there are different few other reasons. I mean, to us, it's a kind of great proxy of value to some extent, and that is one of the reasons that we have one of the highest, actually the highest weight in Berkshire. For last, I think, since we have launched to some extent. But again, the questions are very relevant. We are actually evaluating what we should do in terms of, given that one of the partners have departed. So how we should position itself. But for this cycle, at least we are okay with our positioning so far.
Okay, superb. There are a few questions on the construct of the PMS and the ticket size, so I'll take them up. So there are some questions with regards to, is the Gift City GCP PMS at a minimum of 50 lakhs? So let me clarify. The global compounders offering, which is from the Gift City, the minimum ticket size now is $25,000 and not 50 lakhs. $25,000 is approximately 21, 22 lakh rupees as we speak. But that is subject to the accredited investor norms, which are specified by Gift City. If you don't fit the criteria of the accredited investor norms, then the minimum investment remains at $150,000. We open broking accounts on our client's name, pretty much like the way we do it in our domestic portfolios. This will be a PMS construct in your own name, and we will be buying the stocks, a few more than what Arindam has mentioned in his presentation, in the client's own names. So that's around the construct of how this particular portfolio is built. Just give me a quick minute. I'll go through some more questions. Okay, participants, perfect. We've got a question, Arindam. Global equities are at a high. Is this not a bad time to start with GCP? You may want to re-emphasize on the concept of torque and how we take care of the valuations to some extent.
Yeah, I mean, you're right. So global equities or US equities are particularly at very high level, no doubt about that. So two aspects, I mean, even Indian equities are also at one of the highest level. I think it's all-time high, right? So it is probably true that to some extent investors acknowledge that these are the two best markets to invest in longer term. So that kind of reflects in the valuation. But my point would be that it is about how you want to, stack up your positioning when you're investing in GCP or even CCP, right? So the only thing is how you want to allocate the capital, right? So if you are planning to invest at 20% of your net worth, it is probably sensible for you to to do it in step format. Basically, you kind of distribute it over 12 to 18 months, something like that. But there is no right time to invest in equities. That is my view. And as Hardik was mentioning, we're trying to make sure that the valuation, etc., those angles are being taken care to some extent by the torque framework that we use. But remember one thing, that this is a long-only portfolio. So if the market goes down, we'll also go down. So there is no doubt about that. But at the same time, I would always kind of recommend that invest throughout a cycle. Instead of just trying to time it, it is extremely, extremely difficult. So never really recommend it. The only thing you can do is to make your journey a little easy, to make sure that the volatility is controlled. And that's what we're trying through torque.
Perfect. I think that is applicable for any market, in fact. Rakshit, if you will allow, there are one or two questions which have come in recently with regards to consistent compounders portfolio. Particularly on HDFC Bank, there are a few questions which have come back stating, could we have seen the interest margin issue slightly early? Was there a way to identify that given the merger? And were we sort of aware of the fact that there were high cost deposits on account of the merger that happened between HDFC Limited and HDFC Bank? Any thoughts around this?
Yeah, so HDFC Bank was actually a lower weight in our portfolio until about 6 months ago. And we have increased the weight more recently after the underperformance of this bank has actually increased more recently. So some of these factors we were conscious of. It's very difficult to pinpoint in which quarter how will the market react to a certain number being disclosed, etc. That I think is not a capability that we have. Is there any concern from a long-term standpoint? That's actually a far more important question than could we have foreseen the next 1 or 2 quarters of pain, right? So yes, we did position size a little to take advantage, as in we position sized up more recently after the underperformance, and we had a lower positioning previously. But the biggest question is, how do we see long-term HDFC Bank gaining market share from competition, particularly the public sector banks? There, the conviction remains. It is a far better bank when it comes to the tech stack on which it operates. It is a far better bank when it comes to the penetration that it had geographically 5 years ago. It's a far better bank after the merger with HDFC Limited on home loans. And home loans is one of the largest segments of the lending industry and one of the highest yielding segments in ROE terms of the lending industry. HDFC Bank had a minuscule presence in home loans prior to the HDFC Limited merger. Addition of home loans adds massive muscle to the product portfolio here and the asset franchise. It is a far better bank in terms of cross-sell opportunities across group products, which some of its competitors actually had in a better way than HDFC Bank did prior to the merger. Right. So in many cases over the last 3 to 5 years, it has become a better quality franchise from a forward-looking perspective. Yes, the share price hasn't moved. Does it mean that it's a weaker bank than when it used to trade at 25 times PE multiple? No, it doesn't. This is as much of a valuation opportunity as you would like it to be, rather than saying at 25 times it was probably overvalued, and at 15 times maybe it's a weaker bank, right? That's not the way I think our thinking goes, and hence we are sticking to it.
Perfect. Thank you so much, Rakshit. There are a few questions on the churn in the portfolio that many of our clients would have seen lately, as well as on the churn ratio. So, Rakshit has spoken about rebalancing. Rakshit has spoken about the over earnings or opportunities that are visible in the portfolio. He's also spoken about some of the companies where we've added in the recent past in terms of either increasing allocations. So a churn in the portfolio is visible, and it will most likely continue, Rakshit, if I were to say that. But if you have any thoughts on this.
Yeah, I can give a big picture perspective first, which is till 2-3 years ago, we used to expect about 10% churn related to stock entry exit, and about 5% on top related to position sizing changes. Today, that 10 plus 5 is more like, you can say 12, 13 plus 7, 8, or 10 plus 10. And it has been adding more value. It has been adding more value. We are doing it in a designed manner through either some of the upgrades or learnings that we've had over the past 2, 3, 4 years. And the recent position sizing changes also are in light of that. So yes, that's one big picture perspective. Particular instances, then I mean, I can talk about things which we did till 3, 4 months ago. What we did last week, I will certainly refrain from talking about it. You can always come back 6 months later, and I'll be able to explain what we did in the month of January, February 2024. But yeah, it's all intended to benefit from 3 types of things. One, over-earning, under-earning. Second, expectations of the market being significantly weaker than what we see expectations elsewhere, or vice versa as well. Expectations from the market being significantly excitement-oriented, just because maybe the share price or the recent fundamentals were good, but there might be a disruption on the horizon, which we are trying to factor in. In fact, one of the recent churns is related to this kind of an explanation. Yeah, in general, wherever there are massive opportunities to shave off or add to portfolios, we are doing that.
Perfect. Thank you, Rakshit. Participants, this brings us to the end of this webinar today. We do understand and appreciate there are a few questions which have remained unanswered. We will try to get most of these questions answered and written back to you. For other participants, if you have more questions, please feel free to write to invest@marcellus.in, and one of us will definitely reach out to you and answer as many questions as you would have, either with regards to global compounders PMS or consistent compounders PMS, or any of the offerings that Marcellus has to offer. With this, thank you, Jabir, Arindam, and Rakshit, for taking out time on this Saturday. Thank you, participants, for logging in on this Saturday. And I wish you a good rest of the weekend from here. Thank you.
Thank you.
Thank you.
Thank you.